Assalamualaikum warahmatullahi wabarakatuh and welcome to our presentation. We are from Group KMD on MAB2073 Corporate Accounting and Reporting 3. Our group consists of 4 members. First, Nurul Fatin Sajidah binti Nizam. Secondly, Nurul Kistina binti Muhammad Zulkifli. Thirdly, Siti Nur Maknawiyah binti Mat Said. And lastly, Raja Nur Izzatil binti Raja Anwar.
Okay, for question A, segment disclosures are widely regarded as some of the most useful disclosures in financial statements because of the extent to which they disaggregate financial information into meaningful and often revealing groupings. Discuss this assertion by reference to the objectives of financial reporting by segments. Okay, so financial reports indicate the firm's profitability and net worth as well as its financial performance. Segment disclosures show different aspects of a company's revenue and profitability to its customers. So the objectives of financial reporting by segments are, there are 4 objectives, which is first one, it is prepared to present the users with a clear and comprehensive perspective of the financial component. Second, it is intended to indicate the company's potential to make profits throughout the following years. Third, it should provide a better picture of a firm's performance over the previous fiscal year. And the last one, it shows the company's overall growth and profitability in a single set of disclosures. Okay, so for instance, the disclosure of the net income made, the firm's net worth, the total debt incurred during the fiscal year, and the total assets are all ways to distinguish the organization's creditability. There are also requirements for segment disclosure, which is there are 4 requirements. Okay, so for the first one, all of the pertinent computations of each section need to be disclosed by it. Second, it should indicate the rationale utilized for the measurement of the various segments in the document. Third one, the element should contain or associated expenditures and profits to boost returns for that segment. And the last one, the information must follow standard accounting principles.
Okay, first and foremost, a parent is an entity that controls one or more entities. An entity that is controlled by a parent becomes its subsidiary. So there are a lot of benefits that could be sought by an entity that obtains control over another entity. Okay, so firstly, enhance limited liability. So for our basic information, registering an organization protects it from being held legally responsible for mistakes, error, debts, or devastation caused throughout company operations. Furthermore, a holdings company protects the organization from losing personal assets of a lawsuit of severe debt collection. Secondly, deferred taxes. Company owners and shareholders can temporarily direct their dividends to be held in trust by the business holding company, because this is not the case with dividends distributed out to individuals. These dividends distribution arrangement is advantageous for tax considerations, as well as allowing the holding company to reinvest the aggregate dividend amounts in a suitable investment. Okay, thirdly, reduce taxes. When one or more of their subsidiary companies post a net loss for the tax year, holding and parent corporations can also use this as an opportunity to pay less tax. It is possible to offset this loss amount against the other company's net profit, which will lower the amount of taxes due. Next, low interest loan opportunities. Okay, so in general, a holding company has a lot more success getting a low interest loan than one of its subsidiary enterprise. This is due to the fact that when lenders assess the risk and capital of a holding company, they view all of the shares that the firm owns as a tangible asset that can be quickly transferred to them in the event that the holding company defaults on the loan. And lastly, discrete and cost-effective purchasing. When assets are bought under a holding company's name, they are not only kept safely together outside of business activities, but also allow businesses to covertly buy inventories and other assets under the holding company's separate identity.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Fatih Sajida binti Nizam and my matric number is 1202396. Okay, now we will discuss on why is it important to identify transaction as current or previous period transaction. Basis of accurate accounting is a concept in accounting that stated that revenue and expenses must be recorded in the period in which they are earned or incurred, regardless of when cash will or has been received or paid. Current period transaction affect the account differently than previous period transaction. For example, current period inventory sales affect cost of sales and sales account, while previous period inventory sales affect retained earnings. If the transaction is not placed correctly in the context of time, then the adjustment applied to the transaction may not be appropriate. In terms of the method of consolidation purchase, it is important to determine the date of acquisition. Malaysian Financial Reporting Standards 3, which is MFRS 3, defines that the acquisition date is the date on which the acquirer acquires control over the subsidiary. This is because, under the purchase method, the acquirer is required to enter the result of acquisition operation from the date of acquisition into the consolidated profit and loss account, and measure asset and liabilities acquired on their respective fair value basis at the acquisition date. Further, when a business combination occurs at the end of the accounting year, the determination of the date of acquisition will affect the answer of the question of whether or not the consolidated financial statement should be presented for the accounting year. On the date after the date of acquisition of a company, the reserve of subsidiaries are categorized into two parts, namely, reserve arising before the subsidiary is acquired, which is pre-acquisition reserves, and reserve arising after the subsidiary is acquired, which is post-acquisition reserves. It is important to differentiate, as pre-acquisition reserve represent the net asset of the subsidiary at the end of acquisition and need to be written off from investment costs in the consolidation process because pre-acquisition reserves are not acquired under joint control. Therefore, it should not be reflected in the consolidated financial statement. Post-acquisition reserve also represent reserves acquired by subsidiary after they become members of the group. As such, it forms part of the group's reserve and needs to be included in the consolidated financial statement. In the nutshell, we can note that it is important to identify transaction as current or previous period transaction in the accounting record, as it is totally important to prevent incorrect calculations from occurring.
Well, now for the next question, discuss the purpose of translating financial statements from one currency to another currency. So basically, this question is related to the foreign currency translation. So the term foreign currency translation is a method used by multinational corporations to report the financial transactions of their foreign subsidiaries in the native currency of their parent company. So, to prepare the financial statements of the company or the consolidated financial statements, it is necessary to translate the foreign subsidiaries' financial statements into terms applicable to the local currency. And moreover, a corporation that conducts business in many countries will eventually face the challenge of dealing with multiple currencies. On the other hand, using a single currency throughout an organization's financial statements is essential in accounting. So because of this, translation of foreign currency into local currency is required. So for example, when a company's headquarters are in the United States but has operations in the United Kingdom, so it must convert the British pound to the US dollar. So in general, There are three stages of the currency translation process. First, determine the currency that the foreign entity used in its business operations. Secondly, transpose the foreign entity's financial statements into the currency used by the domestic organization. And thirdly, record the profits and losses from the currency translation. And eventually, foreign currency translation is a part of financial reporting and is used to estimate the amount of money in one currency in terms of another currency's denomination. And without the assistance of currency translation, multiple currency financial accounts would be difficult to comprehend and interpret. So that's all from me. Thank you.
Question E. Why the company need to disclose the related party transaction? The phrase related party transaction describes a trade or arrangement struck between two parties who are connected by an earlier commercial connection or shared interest. A related party transaction is a transfer of resources, service or obligations between a reporting entity and a related party, regardless of whether a price is charged. The disclosure of related party information is thought to be helpful to readers of a company's financial statements, particularly in regards to the study of changes in its financial results and financial position over time, as well as in comparison to the same information for other companies. If two companies in the same industry have nearly identical balance sheets, income statements, and cash flow statements, but only one set of financial statements contains disclosure of numerous related party transactions, the user can make an informed decision about the value of each company. Affiliates, other subsidiaries under common control, business owners, managers, and their families, the parent entity, and trust for the benefit of employees are a few examples of related parties. Even though related party transactions are customary and ordinary, these relationships can have an effect on the profit or loss and financial position of an entity. Related parties may enter into transactions that unrelated parties would not have access to, or into transactions being affected at different amounts from those that would prevail between unrelated parties. The special relationship inherent between related parties can create a conflict of interest that can result in actions that benefit the people involved as opposed to the shareholders. When a related party disclosure is required, the disclosure should include a discussion of the nature of the relationship of the entities involved, and a description of the transaction, including transactions to which no amount or nominal amounts were ascribed, any information a user might need to understand the transaction, the amount of the transactions during the reporting period, along with any change in the method of establishing the terms from the use in the preceding period, and amounts due from all related parties. After reading a complete related party disclosure, a financial statement user can evaluate the significance of these transactions and make a good decision.